Good morning, everybody. Happy Thursday, just after 9 o'clock. June 19th. Markets are closed today for Juneteenth. So we are pivoting to a Trading 101 strategy session. And thought I'd open this time up for a little Q&A. Run a lot of services, talk with a lot of members every single day. We trade the markets. We trade the markets up, down, sideways. 2025 has been an interesting year. 2024 had its moments. 2023 had its moments. I mean, if you name a year over the last 25 years, it's been something I could probably recall. So anyway, all are welcome. Let's let everyone pop in here, say hello, good morning, and let's have a look. So we do have some movement today. Futures markets, double check. I think futures are still open today. Futures should still be running. Yes, yep. So futures market open, Forex market open. Futures are down post FOMC. Here was the noise from yesterday. FOMC very noisy on the day. Let's go after FOMC. Should have been right around that low. So this is around 4 p.m. yesterday. And the low I'm watching would be Thursday and Friday on the futures market. This is important levels. If we go back to SPX, we're not going to know until tomorrow. But if SPX decides that we're going to break, what is this? How's that not S&P 500? Oh, I see. I'm on the wrong workspace. This is with the ACAP feed. Let me go. Actually, let me check on my positions. All right, I have a bunch of pairs trade from the trading battle I did yesterday. NASDAQ short looking pretty darn good. Looking great, actually. Let's see. I might let that run a little bit more. Profit target's already set. It's got to be close. I might be hitting some profit here on NASDAQ. All right, let's go back to this feed. SPX. 1 hour time frame. Okay, so will we be taking out the low from Friday last week? If that's the case, maybe pulling back in some moving averages of this 1 hour chart, bounces off the 5,900 handle, maybe breaks below this 200 moving average. We have room to fall a little bit lower. Okay, so want to bring up some notes. Let's talk shop. Multi-strategy. Up, down, sideways. Okay, we can talk assets as well. So directional bias, if you have one, and asset. So index, stock, options, futures, Forex, crypto. All right. Again, I want this to be as interactive as possible. Feel free to let me know what your favorite asset is to trade. I'll give you my best practices. Up, down, sideways. There's ways that I like to take trades that are going to benefit from no direction in the market, or a inherent bias, which is the indexes are pretty much designed to go higher. They don't always go up, but they do a really good job, probably more than anything else that I have ever seen, of just shrugging off all the bad, climbing the wall of worry, and finding a way through thick and thin to at least stabilize, go higher, almost be rational. So I trade a lot of indexes. I trade stocks. I trade options on everything I possibly can. I trade futures, a lot of futures options. I trade Forex. I trade crypto. Okay. When I say trade crypto, it's more like I invest in crypto for the potential asymmetry. I am right now just position trading in Forex. I don't do a lot of scalping these days. It's been mostly position trading, mostly like large time frame swing trades. So if I see a daily or weekly pattern, 4 hours probably the lowest time frame I go down to trade. Futures market, either hedging through the day, hedging through the quarter, um, maybe picking up some scalps here and there if I sense a good flow. Options. I mean, a lot of the services I run are just options, 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 heavy options, but a lot of ways to get the market tamed. Up, down, sideways, income trades, low risk, like low risk, low reward, uh, low risk, high reward. I guess high risk, low reward. I mean, the kind of the whole spectrum. Okay, individual stocks. Hard thing to be a stock picker. Over the years, you'll discover that if you hold a stock forever and get married to it, oftentimes it will underperform. So I typically don't put a lot of my efforts into finding a stock. Reason why is look, a stock could be great, but if you're allocating, I mean, I'm typically not allocating big chunks of my portfolio to one individual stock. Um, I'll have a percent. If I have in my portfolio now, let's say I have 50 stock positions. Well, I have 50 stock positions. I'm trading a bunch of options around them. I maintain a core position. I track the break evens with spreadsheets, and I know exactly where I'm at. Do I keep making little income trades? Am I going to let this one go? Um, Portfolio review right now. I'll just go through everything. We have oil is a bullish trade with a pretty wide margin for error. I just took this trade this week. Max profit's going to be about $220. Actually, no, max profit's going to be about $720, but most likely the credit that I'll receive on this is going to be about $220. Futures, this one should be looking better. So I've got hedges, copper trades back to break even, hedge. Where the heck did my long-term iron condor? There it is. Okay, so my long-term iron condor is starting to turn positive. This is a futures market trade. I'm looking to see over the next 42 days, are we going to be under 63.50 on the call side? So, I mean, really, do we have a dip? Do we have a dip? Do we have a pullback? If so, this will be pretty good for upwards of maybe $300 profit. That's going to be my max profit on this trade. Okay, so if I see this start trading if my max profit's around $300, if I start seeing this trade at $100, $125, $150, and I have all these trades, I mean, I'll be up a couple grand. I'll take it. That's the intention of the trade. So that's a neutral trade, hedge, neutral trade, hedge, and then some stocks. Alcoa, American Airlines, Apple, Airbnb. I mean, some of it's random, right? I mean, I don't really like having tons and tons of stocks, but I don't own a lot of positions. A lot of these are no ownership, options only, and it's an income trade. Most of these are income trades. Okay, so let's go back to the notes here. Let's talk up. Give me some chat. And how do you trade the market up? What are some of your favorite strategies to trade the market up? We can go from as simple as to complex as you want. If you're trying to trade the market up, you can obviously buy the underlying asset, right? If you want to buy a stock and the stock goes up, you make money. You buy a futures contract, spot price goes up, you make money. You buy a currency, spot price goes up, you make money. You buy Bitcoin, Bitcoin goes up, you make money, right? So it's directional. We see profit if direction is favorable. Okay. I'm gonna pair a lot of these with kind of option positions. Another way to be bullish in the market or benefit from an upside move. There are some pretty simple ways to do it. Sell put, especially if you don't want to own something, you can sell a put, which is the intention to own. But if the market goes higher and it never crosses your put level, you don't get assigned stock. You don't own it. You just collect income. You can buy a call. Okay, buy a call is basically leveraging what would be like a one contract call is representing 100 shares, and it's a derivative, right? So you're buying a contract that represents a chunk of 100 shares. You need that asset to go up. Just buying calls to me is sometimes the most difficult trade to get right. because you need the price to go your direction. You need the price to go up quickly and hopefully cover what you paid. Okay, so you do have time and price that can work in your favor, but time is usually your enemy when you're long options. Okay, if you sell a put, time is your friend. Time actually helps the option decay, and that time premium that typically works against buyers. Like if you buy a call, time premium works against you. But in the sell side, you actually want that to decay and basically finish out of the money so you collect the full income, right? Buying a call is great, but you need direction and time to be very friendly for you, and sometimes it's challenging. Okay, I typically like spreads. I could do a bull call spread, which means I buy a call at a little lower strike, sell call at higher strike, and if price goes up and closes above the higher strike, the full width of that spread is mine. So, for example, let's say that I trade. We'll say the SPY. I buy the SPY with a 600 call. I sell the SPY with a 610 call. Okay, this is just an example. So if I write this out, so let's say I buy the 600 call and then I sell the 610 call. Let's say I pay, I don't know, $4.50 debit for that, because right now it'd be slightly out of the money on the trade. So $4.50 debit. Okay, that gives me a max risk of $4.50 per contract. So that's going to be $450 would be my max risk if it's one contract. Max profit would be $10 per contract, which would be 1,000. The net max would be 550, right? So if I let price go and we're above 610 by expiration, I can make 550 bucks. I was risking 450. It's pretty good. It's over 1-to-1. Okay. But that way I eliminate a lot of the power that time plays in a long option. I just need price to be above a strike by a certain time. So if I went out 30 days, I have 30 days. If within that 30 days, price is at 612, 613, 614, within that 30 days, I can see partial profit. I won't necessarily realize the entire profit, but I can see partial profit, and that's still maybe good enough. I take a 450 debit, turn it into maybe $100 or $200 profit. Maybe I walk away, get out of the trade early, not have to wait, not have to wonder. So there's ways to manage partial profits. There's ways to let it go all the way to expiration. And anyway, pretty simple trade. That's a debit spread. Okay. Next up, one of my favorites is a credit spread, bull put spread, which is I sell a put at higher strike, and then I buy a put at lower strike. I collect credit. This one is a debit. Okay, so credit example. Let's use the SPY example again. If I were to sell the 600 put and buy, let's say, the 595 put, and I collect, I don't know, $1.75. $1.75 credit. So $1.75 credit. $1.75 credit would be my max profit. And the 325 remainder, that's the width of the spread because it's 5 wide, would be my max risk. Okay, my break-even point would be 600 minus the $1.75. So 598.25. So in order for me to not lose on the trade, as long as the SPY, this example, if we stayed above 598.25, we're still break even or better on the trade. Okay, that debit spread example that I did for the 600 by 610 with 425 or 450 debit, the break even price would be 604.50. So you'd have to have price be at least above 604.50 to cover the cost of your trade. Credit spread, you're actually lowering into the price of the asset. All right, but there's a bit more risk in this trade than there would be reward. That's part of the trade-off. One thing you'll notice with option trading is there's typically a trade-off. You want high reward, you're trading a little bit less probability. You want high probability, you're probably trading a little bit less reward to risk ratio. Okay, You'll see it. Like the more strategies you start to implement and incorporate in your option trading, you'll notice there is a trade-off. I'm a big fan of defined risk. I know there's some strategies out there that love undefined risk, which is selling strangles and naked everything. That's fine, but at least do that with the intention of having a backup plan, whether you want to carefully monitor those positions, roll those positions, or be prepared to own something. Okay, because you could be assigned. I mean, if you're doing like SPY or QQQ, you could be assigned. If it's indexes, you're probably not taking naked plays because it's so expensive. It's going to tie up all your buying power. So anyway, we'll get into that more in a little bit. Does that make sense? So up, you can buy the underlying asset, you can sell a put, just collect the credit. And if it stays higher than your sell put level and your break even price, you make money. You can buy a call. Like I said, time does not work in your favor. You need to cover the cost of your premium. And usually, like I've said this before in a couple of sessions, usually with time, I would say you really need price to move quickly. And if you're profitable by the halfway point, best to protect. Okay. So for example, if I put a trade on, let's say I buy a call on Palantir. I think Palantir is going to be the greatest stock ever. It's going up to the moon, whatever, or Nvidia. If I buy a call, let's just use Palantir as an example. If Palantir is trading for $100 and I'd go out 60 days, well, by day 20 or day 30 in that trade, if I'm in profit, I probably want to start protecting that profit. You can put in a stop loss on that buy call trade. You can put a stop loss above that debit, so you can at least collect some income. But what happens is time is not your friend. So when you start the trade, let's say I went out 60 days. Well, day 0 or day 1, all the way to 60 days, this is time decay. Okay, so time, when you're long an option, gets to the point where around this halfway point, around this 2/3, you start to experience a lot of aggressive time decay. And that means that you're getting less and less time value in the trade. So if I went out 60 days on a buy call for Palantir, if by day 20 or 30 I'm in profit, it's probably the most capitally efficient for me to take that profit and protect it, as opposed to hoping that Palantir just continues to run, rip, because maybe it does. But if it's already exceeded the expected move, it's just going to be harder and harder. Time is not your friend when you're just long options. Okay, how do you determine expiration? That's a good question, Larry. So for me with expirations, let's throw that in here. So determine expirations. Also miscellaneous notes here. Q&A. So if you have questions, feel free to type them in the chat, and we'll address them. So how do you determine expiration? I'll just give you my best practices. So for me, I would say, I mean, a really good book from Tasty Trade. It's from Julia Spina, The Unlucky Investor's Guide to Options Trading. Really good book to break down just the math of trading options, the core strategies of trading options. Tasty Trade has done a phenomenal job of creating an entire network for traders that is just mostly selling options. I mean, they have discussions on everything. I mean, you can go into their archives, their broker platforms, and their their demos, and they've got tons of content online. They talk about all sorts of different strategies, understanding them. But for the most part, their tried and true strategy will be, naked strangle or an iron condor, selling premium. I do a lot of ratio spreads. I know Tom Salzman likes a lot of ratio spreads, but their ideal trade is like a 45-day sell, okay, because it's kind of the optimized time decay. So it's long enough that it's not hyper amounts of risk on like a delta gamma exposure. And the ideal trade is you go out 45 days and you manage at 21 days. So like I said, about the halfway point. Okay, so I think for me, like a standard trade would be like 30 to 60 days. I like a lot of 40s and 50s as well, but between 30 and 60 is typically, I'd say a safe window would be 30, 45, 60-day for kind of these swing trades and expirations. Okay. And well, I mean, swing trades might be the wrong word. I'll just say 30, 45, 60-day expirations for most options. Okay. If I'm bullish on something, if I believe that I'm building a case for, I think I want to invest in this, but I don't want to buy the underlying. If something's very expensive, then I will go out longer. Okay. I don't mind going out, like the 120 day isn't bad. Obviously, the 360 day isn't bad, and sometimes they even go 720. Okay, these are to me like the longer term expirations. So, for example, on TLT, so trading the 20-year the 20-year bond, I went out to January 2027. So I went out 2 years on that trade. Now, I don't want to just buy out 2 years and then just wait and see what price does. What I'm doing is I'm buying the long dated and I'm going to sell against it short term. So I go out long dated, and every 30 to 45 days, I'm selling something against it that's at least my break even, and I'm trying to lower the cost of my debit. I'm trying to lower the cost of that trade. Make sense? So trades I'm doing that on right now, I'm trying to think. I know Pfizer, I'm out to 2027. TLT, I'm out to 2027. Got a couple. I think I've got a couple other ones. UNG was out to 2027. That's natural gas. Anything else? I did a lot of trades this year on like IBIT, MicroStrategy out to January of this year, or I'm sorry, this next year, 2026. So, I mean, to answer Larry's question, it really depends on the trade. Um, Zero DT is a whole new beast. That is great. I mean, I trade every single day. Daily Profit is one of my services. We trade the indexes every single day. Waterfall Income, we trade the indexes every single week. It's just a Monday trade. It's opportunistic. So I mean, if the market really cooperated on a pullback on a Wednesday, then I'd probably still put in a swing trade with Waterfall. Um, Double up is more, I assess the market during the week. Newsbreakers, I assess the market during the week. Pinch point, I've got a scanner now that sends me fantastic trade ideas. We already have 20 some trades running for the last couple of weeks of that scanner being live, and we've already closed out 4 winners. We had one small loss, 4 winners, and it's great. Like I'm given so many good trade ideas without me having to go find them. Okay. Is this recorded? Yep. This will be recorded. This will be posted on youtube.com/Chris Pulver and youtube.com/Financial Wars. I've got it in my restream so I can have a recording as well. But yeah, this will be posted on the channel, and this will be popped up with that thumbnail trading 101 strategy session. And yeah, it'll be on the channel and archives. Okay. Larry, does that help? Okay. Now remember also, if this is for option trading, I mean, if you're just buying the underlying, you don't really need time. That's kind of the nice, but if you're an investor, then your horizon is 3 years, 5 years, 10 years. I'm going to buy and hold this thing forever, right? That's fine. But it's obviously, if you're going to go out long term, I always want to have a backup plan. If I'm going out long term, I also want to have a hedge plan. I want to have the ability to manage risk, or at least mitigate risk. Example, if I bought the S&P 500 or the SPY, and I bought it like at these recent highs at 601, 602. I love how I just had an opening bell on my broker platform and nothing is moving. um, but if I bought the S&P, I mean, okay, let's say you bought the S&P this year. Okay, let's say you bought the S&P this year. Let's go to January 1, just to have a fun little experience of what this year would have felt like if somebody just invested all their money in the S&P. So let's go to January 1. Okay. So right here, I believe that's the first day of trading this year. Yep. So we go December 31st to January 2nd. I'm going to put a blue line on here. Okay. So that blue line represents if I bought the S&P the first day of trading this year, what would have happened? Okay. And let's say that I put in, you know, $10,000 invested in the S&P, $100,000 invested in the S&P. What have we experienced so far? Well, initially we buy and it goes up, and we're all excited that we're up 2%, and all of a sudden we're down 2%, and all of a sudden we're up 3.84%, and then we're up 0.4%, and then we're up 4%, and then we're down 6.5%, then we're down 2%, and then we're down. Let's keep going. So we would be down 6.6, down about 2%. Then we go down. That is so ugly. We were down 18%, and then we're back up. So right now we're sitting up a whopping 1.19% after, 6 months, almost 6 months of trading. So my $100,000 is up $1,000. That's a lot of money to be fully invested to be up $1,000. Okay. And that's also a lot of money to watch, nearly $20,000 in drawdown to give you $1,000 on the upside. Now, granted, if you didn't do anything to manage that, it's just a lot of emotions. Market was down 18%. That's going to feel really crazy. Do I get out of the? No, you don't get out of the market. Okay. My plan always is to never be fully invested. I don't want to be fully invested. I want to be. The reason why is I want to have opportunities like this when they do happen. I want to have dry powder and cash to still buy more. Okay. Unfortunately, a lot of people that are fully invested don't have the benefit of buying more and buying more and buying more if it's offered. If we're buying more, buying more, buying more, okay, we're actually showing a lot more profit than had we just put everything in one position. So if it's an asset you want to invest in, I mean, that's just simple dollar cost averaging. So even for like 100% allocation, in truth, I would say I would still want to have maybe 80% invested, not 100, because that 20% can make a huge difference. Okay. So let's say that you're like, you know what? I just want to trade the S&P. I want to make it easy. I want to be a passive investor. I've got $100,000. I'm going to put $80,000 in. Okay. I'll put $80,000 in. Okay. Let's just talk through that. You put in 80K, but you're willing to invest up to 100K. So you did 80K right here. Okay. Which is up about 1.19%. We'll do the math on that in a second. But when this market drops, let's say the market dropped 10%. Let's find that 10% decline. Okay, so 10% decline right in here. Oh man, that would have been during right after Liberation Day. You get your big gap. You're in 10%. Day opens and still draws down, but you're down. There's a 10% discount. You put in another $10,000. Okay. Now to be fair, let's say the $80,000, and you're like, well, if it's going to go down 20%, I'll take another 10K position. I'll go fully invested at a 20% discount. Okay. Well, we got to 18. So in hindsight, it's like, did it get to 20? No, because 20 would have been down at like 4,700. You didn't get the trade. Did you throw in another $10,000, maybe another 5,000? Let's say we did this. Let's say because of that pivot that Trump had on April 9th, you ended up putting another $5,000 in on a pullback. So we'll go right here. So we'll go 10K right here, and we'll go 5K. I'm not even going to make this super precise. I'll go 5K right here. Okay. Now let's talk through this investment. This is just one asset. This is trading the S&P. Dollar cost averaging. The intention is I just want to buy and hold, but don't put all of your money up at one time. Okay. Have a little bit of dry powder in case the market offers up some discounts and pullbacks. So my $80,000 is currently up around 1.27. So let me type this out. So we have 80K. 80K is plus 1.3%. We have 10K. 10K on the open of this candle. Okay, 10K is up around 12.92%. 12.92%. And then you have another 5K, and I'll just buy it at the end of that day. That is up another 13.19%. Okay, so let's do the numbers. So 80K, so 80,000 times 0.013, you got $1,000 profit right there. So this is 1040. Let's go up here, equals 1040 profit. You have 10K up 1292, which is up 1292. And you have 5K up 13. So 5 times 1319, up $659. Okay, so that total with a little dollar cost averaging and most of the position at the top, okay? But even that is doing better. You're up almost 3% versus the S&P up 1.3%, you're up 3%. I'm not saying this is something to be super excited about, but I'm saying just a little bit of dry powder can still improve. And if it did go down 20%, that's obviously going to have a huge impact, because if we were down 20% and we come all the way back up here with a 25 to 30% rally, that's, $2,000-$3,000 on that 10K, even though you're heavily invested. So there's all sorts of ways you can think about this scenario. Well, I'll only put, 50K in at a time, and 50K here, then 10, 10, 10, 10, 10. That's fine, right? But there are, programs and mandates and mutual funds where they're fully invested almost all the time. And if they don't have any downside protection, it doesn't make life much easier outside of holding until these assets can go up. Does that make sense? All right. So anyway, dollar cost averaging. It's pretty tried and true. It does work, not in everything, but it does work really, really well. Up, I mean, we can add that in here as well. You can dollar cost average. So that's essentially buying the underlying asset. Dollar cost averaging is, in my opinion, you're buying the underlying with percentage pullbacks, right? So, and the nice thing now is with fractional shares, you don't have to have hundreds and hundreds of shares of anything. If I like, look, I have $1,000 that I want to invest in, Palantir, great, like best stock of 2024, Palantir. If I think this stock's gonna be a high flyer, has a lot of upside potential, and I've got $1,000 I can put into it, do I want to jump in and put $1,000 right into Palantir, or would it be maybe put in 500, reserve another 200, reserve another 200, maybe another 100, give myself some wiggle room, give myself 10, 20, 30, 40% wiggle room to invest at better levels, be fully invested at a discount. That way if the market goes higher, makes new highs, you're invested. Then you can take profit chunks, then reallocate, do the same thing on repeat. A little bit of technical analysis, we get overstretched, we seeing the overall market bullish to support the theme that my favorite stock can go up. If the S&P is not going up, we're typically not going to see a lot of individual stocks sustainably go higher. The S&P is like the broad market for a reason. If the S&P is down, typically about 2/3 of the stock market is down with it. If the S&P is up, typically about 2/3 of the market is up with it. So this is a good barometer for, should I be holding a stock long when the entire market's sideways? Should I be holding a stock long when the entire market's going down? Probably not. So just a barometer. Make sense? Okay. So to trade up, buy the underlying asset. Okay. Dollar cost averaging, option trades. Like I said, selling a put, you just collect the credit, potentially assignment. Down market. Well, no, I'm never going to prescribe this one, but selling the underlying, no. I'm never going to sell the underlying on margin, right? So I don't sell stock. What I would do is I would buy a put. If I want to go bearish on something, I buy a put. You pay for the debit. Same thing. It works. It's the buy call in reverse, right? So I'm buying for the directional play. I pay a debit. I want to see that price moves down quickly and covers my premium. I want to see price fall maybe it's a technical hedge. Maybe I believe the market's going to fall. Maybe I think that this is the best way for me to profit cost effectively to the downside. Okay, so you can buy a put. You can do a bear put spread, which is I buy a put at higher strike and I sell a put at lower strike. It's like a debit spread, like the bull call spread, but in this case, I buy the put at a higher price, sell the put at a lower price, pay a debit, and if price is below my lower strike put, I keep the width. So just another quick example, easy example on the SPY. If I do a bear put spread on the SPY bear put spread. If I believe we're going down, I buy the 600 put, I sell the 590 put. Let's say I pay $4 debit. So $4 max risk, $10 max credit, which would be a net $600. Okay. My break even point is going to be 596 or lower for profit. Make sense? So as long as the SPY is under 596, I'm going to see profit on this trade. If the SPY drops a ton, it's down to 580. Doesn't matter. This is still risk defined. So the most I can make on the trade is $10. If we're all the way down to 580, if there's still time left in the trade, that $10 max credit might be close. It might be, $8.50, $8.75, $9. Just depends on how much time is left in the trade. Okay, but I just need to cover the cost. And this is a way cheaper way to trade, the S&P or most stocks for that matter. It's a way cheaper way to trade the downside as opposed to just buying a put. When I put on a lot of my hedges, we talked about this in my crash insurance masterclass. I do debit spreads. I do a lot of debit spreads when I'm hedging the markets. I hedge futures. I hedge the SPY, the Qs. This week I put on a trade on QQQ. I put this into my Telegram channel. It's an out of the money trade. It's way out of the money. Okay, but I only paid $490 for this trade that potentially could pay me over $8,000. So I don't think that I'm going to make $8,000 because it has to go all the way down through my strike prices and do it at the end of expiration. Unlikely. But if I see the reward to risk scenario where I can make, 16 to 1, if I can turn that into a 2 to 1, 3 to 1, 4 to 1, I'm pretty happy with that trade. I don't need price to go crazy low. Make sense? All right. So that would be a bear put spread. It's a debit spread. I like those a lot. Bear call spread, that's a credit spread. That is you sell a call at the lower strike and you buy a call at higher strike. That one is for a credit. So debit here and credit. So the credit is the line in the sand. So if I thought the SPY is going to stay below 600, then I can sell the 600 call. Let's say I buy the 605 call. I collect, a dollar, I don't know, $1.90 credit. Just an example. So $1.90 is going to be my max profit. $3.10 is going to be my max risk. My break-even price is going to be 601.90. As long as the S&P stays below 601.90, I can make full profit on this trade. So directionally, I don't really have to have the thing do anything outside of respect my line in the sand and stay below it. So if it's below 600, I keep full credit. If it's 601.90, well, it's inside my strike. I still am break even or better, which is fine. I don't really want to take assigned shares, right? If I'm inside the strikes, the market's going to say, oh, this trader wants to sell the S&P at 600. No, I don't. I want to close out the trade. Okay. All right. So that's simple debit spread, credit spread. To me, there's not a dollar cost average scenario on selling, unless you're going to use options and you really hate a stock. I wouldn't do anything to the permanent demise of a stock's direction. And look, there are firms that literally do this. That's all they do is they find stocks that they believe fundamentally and technically should be going lower, and they just trade them to the downside forever. I've never done that. I've never done that, and nor would I. So currencies, I mean, you can trade to the downside in currencies. If you thought the dollar is going to be weaker, you dollar cost average into the dollar. If I believe that Gold right now is likely going to have a pullback. Then you could dollar cost average into the dollar or the gold trade, but still have a plan, like have a stop loss plan. It's not something you want to permanently be doing, right? I don't want to be stuck in a drawdown. Okay. All right. Does that help? So some just simple directional plays. Sideways. Let's talk sideways. Again, these are kind of option trades. I don't know, like a pairs trade is pretty good for sideways market or just volatility, right? If you took a look at the trading battle yesterday with myself and Blake Morrow, every trade that I put on, I did a pairs trade. So I did euro, dollar long, and I did dollar Swiss long. They should go opposite directions. So the reason I trade them both long is because if the dollar gets stronger, euro dollar goes up, dollar Swiss goes up, right? So if euro dollar goes long, I'm going to lose if I want to see a stronger dollar, for example. I'll benefit from dollar Swiss, but I'll lose on my euro dollar. But I'm hoping that one outpaces the other. So if dollar Swiss goes up by 100 pips, euro dollar goes up by, you know, I guess 50 pips, or I stop myself out at 100 and I let the other one run to 200. I'm trying to go after a bigger win than loss. So I give it a little bit of breathing room, but I take kind of the opposite trade. I did this yesterday also on the Nasdaq and the Russell. So I went Nasdaq short, and I went Russell long. Okay. So in this, I did Russell growth actually. So Russell growth long. Because the volatility, it about matches. So if the Nasdaq's going to go down 1%, the Russell goes up 1%. Hopefully that's enough to hit a take profit and cut my loss off a little bit faster. Make sense? All right. So pairs trades are pretty good. Sideways markets, let's talk some option strategies as well. Directionally neutral strategies. My daily profit play is directionally neutral. Okay. We can trade this on indexes. We can trade this on ETFs. We can trade this on stocks. We can trade this on futures. You can trade this on, futures that does include gold, oil, silver. If you have crazy amounts of futures options, like literally trade platinum, corn, soybeans, treasury bonds. Like you can trade a lot of this stuff. It's a good trade in the sense that if you believe the market is not going directional, what this is essentially it's a seller's go-to strategy. Because generally speaking, the market, the expected move in the options market is typically greater than the actual move. This is especially true in a higher VIX or higher volatility environment. Okay, case in point, when we saw the Liberation Day, post Liberation Day, the big sell-off that we had in late March and April, I was looking at the implied volatility ranks on the S&P, the Nasdaq, the Dow, the Russell. Everything was just exploding higher. We saw the VIX go to 60. Okay, that was I want to say the third or fourth largest VIX move ever to the upside. It was also one of the fastest volatility reversions to the downside, like ever. So what that means is by the time we got up to the 40, 50, 60 VIX level, if you were selling options with those high VIX environments, the implied volatility move was so wide that the actual move didn't hit it. Does that make sense? So let's talk as this market is dropping. Let's use this example. As the market is dropping. So as this market is dropping hard, I was going down to, on the SPY, I was going down and selling like $350 SPYs for like $5. I was selling like, $300 Qs for $3, $4, $5. And that was within like maybe a 40 to 60 day window. So essentially I looked at this and I had trades on for March and April that from peak to trough, the S&P, the Nasdaq would have had to have been down over 35% for that trade to have any type of real risk to it. Now there's volatility expansion and there was drawdowns that I was dealing with, but as far as the actual strike price, a 350 SPY and we're trading at, 480, I had 100 and some points of wiggle room. As the market's already down peak to trough 20%, I went out another 10, 15% of margin for error. So those were never a sign that was never threatened. And as soon as price pivoted, all of a sudden that direction was helping me out. The time decay was accelerating because now price is going the opposite way, which was helpful for me. And I didn't have to hold the trade's expiration. I was closing out for about 85 to 90+% of that max credit within, 20, 30 days. Okay. So it's nice when the implied move is far bigger than the actual move, because as a premium seller, you can make a lot of money. So when the volatility index is higher, um, sellers do really well. Sellers do really well. It doesn't come without risk. Usually, if you're selling premium, especially out of the money premium, you typically have a backwards reward to risk profile. That's the only thing to be cautious on. It's like iron condor is a good example. I go, a 10 wide iron condor. I go for $1 credit. I'm risking $900 to make $100. Most traders look at that and think like, that's insane. I'd never take that trade. Well, if you win, 81, 82% of those trades, you're going to make money. Okay. But what's better is when you win 91, 92, 93% of those trades, you make money. So that's the trade-off. Is it still works. Like the math still works because your win percentage can be so high. And honestly, you'd be surprised how good that premium is if we have a longer duration. So if I went out like 45 or 60 days and the expected move is so big that we're collecting, I mean, that long-term iron condor that I put on, um, I mean, I'm potentially making like $300 in like a 60-day trade. That's not bad. I mean, for a little trade that I think is directionally neutral, I'm hoping that's good enough. Okay. All right. Again, keep the questions coming. I'm going to go for maybe another 10, 15 minutes. Let's just kind of keep talking through things. Indexes. I mean, to me, this is S&P, NASDAQ, Dow, Russell. Whereas your Russell small cap, S&P is your broader market, NASDAQ is tech, Dow is your kind of blue chips. Um, I mean, that's a pretty nice basket to have. Small caps, they can perform really, really well. They can also underperform and be like the riskiest. As far as, I've got an aggressive profile on my 401k. Well, you're probably going to be in some small caps, just because when they do grow, they typically outperform. Um, but when they struggle, I mean, S&P has performed great the last 20 plus years. NASDAQ has performed great. It's been one of the best performing indexes in the last 30 years. Like since early 90s, when the NASDAQ came on board, electronic trading became a thing. NASDAQ's by far outpaced the S&P. Does have more volatility, but reflexive wise, I mean, tech is like what the U.S. owns, and I mean we have companies in the U.S. with $1 trillion+ market caps that are bigger than countries. That's how big some of these companies are. Stock, you can trade, the high flying stocks. You can chase momentum. Top 10 in the S&P, top 20 in the S&P, top 10, 20% in the S&P and NASDAQ. That you kind of get that concentration of high performance. You can also flip that around and be a value investor, which is, take your bottom 10, bottom 20% and hope that there's enough value in those trades that they're so cheap that if anything goes right, it's a lot of upside potential. I don't like that necessarily. I wouldn't call myself a value investor. I like things to be fair and I like things to be on sale, but I don't like to invest in what I call dead capital, which is, I mean, hey, the S&P is up 20%, the stock is down 75%. To me, that's not an attractive play. The broad market should represent the health of the stock market. So why is it that an individual stock could be down 70, 80, 90% and I'm getting excited about buying that thing? No way. If it's not correlating with the broader market, to me, there's something wrong fundamentally. Okay. Option trading on everything, like I said. Futures market. I've got a lot of traders that are on my Discord that are trading futures. They trade prop firms. They do pretty well. It's not easy. It's a lot. It's a ton of grinding. Um, if but it'd be the same as scalping forex. I mean, I was a day trader in forex for a couple of years. That was with one of the professionals that I worked with. That's all he did. He managed one currency pair, euro dollar, just traded, tried to grab 20 pips a day. Just aligned his 1 hour chart all the way down to a 1 minute chart, and took his trades, had super precise entries. Did deal with a little bit of noise, but it was just management. Tried to catch a flow for the day. At that time, this would have been like 2007-ish, 2006, 2007. And at that time, the euro dollar, daily trading range was about 150 pips a day, 200 pips a day, like pretty good. Now we don't see that. Now we're seeing euro dollar maybe move, 60, 70 pips a day. So very different volatility profile. But it still works. I mean, the alignments still work. Instead of expecting 20 pips a day out of a currency pair that can move 200 pips, how about going after 5 to 10 pips? It's still profit. I mean, if it's a bigger contract size, it's similar risk reward, but you can find a really good precise trade. Futures, same thing. Futures market trades 23 hours a day. Forex market trades 24 hours a day. Crypto trades 24 hours a day. Crypto for me is more just investment. I like Bitcoin. That's it. I've had Ethereum. I've had Solana, I've had Litecoin, I've had Batcoin, Gemini. I never got into Shiba Inu. I never got into Doge. I didn't chase that stuff. I just the money that I did make, Ripple was another one that was pretty profitable on. Those dollars and profits, I just ended up kind of concentrating them into more Bitcoin. So to me, I look at crypto as a percentage allocation, and I'm trying to, in a way, like invest and hold. I think the upside is pretty nice. I think that the potential hedge against money printing is what Bitcoin might ultimately stand for. It's been nice to see the mainstream adoption the last couple of years, seeing that BlackRock's in the ring with it. There's ETFs now that are approved. It's easier for people to get on board and allocate. Financial advisors are talking about a lot more like everyday sit downs with their clients, putting on at least like a 1% exposure to Bitcoin. They're certainly years late, but it's better late than never, especially if it continues to be an appreciating asset. Okay. Um, I saw the question on dollar CAD there from JRC. I mean, this was not a live analysis session. I'm doing another session here in about 15 minutes. But if you want to see dollar CAD, sure. I mean, it's going down, right? It was going down. It didn't quite hit my support level that I wanted. I was trying to get down to like 3,400. It never got there. So we pivoted pretty hard here on dollar CAD. Um, to me, this isn't a buy trade yet. I think if anything, this is still a fade the rally. If we come up, I mean, look, it's a trend line. There's a trend line resistance, resistance, resistance. If we come back up into this area again, there's a lot of resistance here. If this like 38, 3,900 resistance holds and this thing turns back around, I mean, that's a pretty good trade. You can look for a U-turn, sell this thing nice and high. Confirm on a lower time frame. We're going back down. Trade stop loss above a little swing and see if we can take out the lows and continue to push lower. So that's what I see on dollar CAD. If I go to currency strength today, we have the Swiss. Interesting. The Swiss did they cut rates today? We see New Zealand and Aussie way weaker today. We see the CAD at baseline, Japanese yen a little bit stronger, dollar, euro, pound, Swiss on top. Did the Swiss cut rates? They did cut rates. So the Swiss cut rates to 0.25 and the market didn't move. We had a dissent in the Monetary Policy Committee for the Bank of England, but they still held rates at 4.25. So anyway, I mean, holiday trading, I guess, but this is certainly showing some risk off flows overnight to see either something happen in China. This is around 8:30 p.m. Eastern time. Something happened in China for these currencies to go down, or there's just a bit more post FOMC risk off trading. And unfortunately, because today is a holiday, the U.S. markets are closed. We might not really see this reflected in the stock market until tomorrow, if these type of flows continue all day. Okay. All right. What else? A couple more things. Well, I've got just maybe another 10, 15 minutes before I jump into my next session. Any other questions right now? What I like to do is talk about, strategy, service overview. Okay. So just, how can you trade with me? I'll give you some examples. Daily profit play. Daily profit play. I trade the indexes. So index trading, I just put daily index trading. That's what it is. Okay, so I meet with my members every single day, and we are grinding out profit. That's our goal. We are averaging about 89% wins. I've got some members that do this literally full time, like it's the only trade that they have. It's the only trade they follow. It's their bread and butter, which I'm I love that they've made that kind of their exclusive trade because it's so easy to follow, and it's also an opportunity to not have to overthink it. You step in for the day, you try to win the day. That's it. Overnight risk. What's Trump going to say? What's the Fed going to do? What about this global trade war? Doesn't matter. Just trade the market. Okay. It's dynamic. If the market moves with higher volatility, we can trade higher volatility. If the market slows down, we can trade it. It's like it's a really flexible service, which I like, and it's something that we can do every single day. Okay. Waterfall income. This is a index swing trading strategy. We meet every week. So we meet Mondays. We meet Monday through Friday. Today, no class because the markets are closed. On waterfall income, we meet on Mondays. We typically take some trades on SPY or Qs or XSP, SPX, maybe NDX, and it's just kind of designed to let us benefit from what the market does best, which is find ways to grind higher. Okay. All right. That's waterfall income. I have double up. This is a high reward, low risk index or ETF or Mag 7 strategy. That's all I focus on. Most liquid stocks. I mean, Tesla at one point this year had more option trades, had more option volume than the SPY. That's crazy. An individual stock had more option volume than the SPY. Like average trading volume was higher in Tesla than it was SPY. So, I mean, I include the Mag 7 because they're super liquid. What is coming soon? I'm not sure exactly when this deadline hits, but in the next probably, I would say by the end of the year, we are going to see Mag 7 stocks are going to be offering day-to-day options. So we could trade 0 DT on Apple and 0 DT on Amazon and 0 DT on Tesla. That's going to make these things really interesting. I don't know if it's going to be like good or bad. I mean, it stabilized the markets a lot the last 3 years, right? Like this is essentially a 3-year anniversary of 0 DT. But if they start introducing that to Mag 7, and I think that's pretty exciting. But the double up service it's all high reward to low risk. I want to try to get a trade that offers me, 5-to-1 reward to risk, 10-to-1 reward to risk. And my goal is to try to turn it into a triple digit winner. Okay. Let's go news breakers. So this one is, I'm looking for a major market catalyst. Sometimes it's earnings. Sometimes it could be like a merger. Sometimes it could be, broad market movers. Sometimes it could be, I don't know, big picture. Like, hey, we've got FOMC, we've got non-farm payroll. We have something that's going to cause the market to move, and we'll see if we can benefit. Newsbreakers, typically, I'm trading individual stocks. A lot of them have earnings trades. We can trade it up, down, sideways. We've had earnings season kind of fizzle out here the last couple weeks. And the last trade I was in was Adobe. That was last week. By the way, if anybody's in my newsbreaker service, that Adobe trade, I took a small loss. I lost like $90 on the trade. By the end of the day, that trade would have offered about $400 profit. So it was right on the left side of our risk graph, and that's why I took the loss, because if it stayed lower for the day, I was risking like $1,000. So I'm like, I'm down 90. The market moved a little bit further than I wanted for day one. It was like a day one earnings trade, and I mean, whatever. I took $90 loss. End of the day, it was $3 up to above my like kind of break even price, and that $3 translated to about $300 credit. So still, I mean, again, hindsight's 2020, but I'll take the small risk. But still, the trade strategy was sound, and we've had a lot of good winners in that service. Okay, this could be earnings as well. What else? I have Pinch Point. Pinch Point. So this is a scanner dashboard. It's also, I mean, I'm going to say AI because look, a computer is technically AI. It's programmed. My Pinch Point scanner is programmed to produce trade ideas. So AI trade ideas on coiled, wedged, primed stocks. So it's basically, if prices are pinching, that means that at some point that energy in the markets have to go somewhere. It could be volatility expansion. It could be an earnings catalyst coming out. It could be something in the broader market cycle. It could be an OPEX, which is when you have futures expirations, stock expirations, index expirations, all coming together in one. Like that's what this is. We have monthly expiration, quarterly expiration. We're gonna have futures expiration. All these things kind of hit at one time. Pinch Point is helping me take like literally 9,000, almost 10,000 stocks, and it spits out maybe 20 that are tradable and actionable. Okay. I mean, there's a lot of stocks that are tradable, but I'm looking at where if I can search through maybe 10, 20, 30 stocks that are all primed and ready to move in the next 30 to 60 days, I love that trade. So Pinch Point has allowed me to, really take a lot of a lot of I guess I'm benefiting from having bonus time. You know, it used to take me hours and hours and hours each week just to search. Put on some scanners, put on some filters, find some trades, go into dashboards, look at snowflake analysis, maybe find a couple of things that qualify, then go find a trade, price it out, maybe take the trade. This one is spoon feed me based on the logic that I want to see. Spoon feed me great trades, take a setup, verified in the option chain, take the trade. Traders know this in my pinch point scanner. In my pinch point scanner, we have probably thrown away 80+% of the trades we've looked at. Just because if it's not precise enough on the option chain, if it doesn't price out for me to have something asymmetrical, where I can have like at least a one to one, I typically don't take the trade. So I'm going after something that I think is realistic pricing wise. I want it to be, to our benefit to at least hit my take profit levels. But the nice thing is I literally save like hours and hours and hours of analysis, hours and hours of searching and finding, and it just delivers me the stock. So that makes it a lot more fun. I don't care if I throw away a bunch of trades because honestly, like this week, I haven't had a live class, but let's do this for my pinch point. I think we'll have a class today. Just we'll review everything, make sure everyone's comfortable. I've taken I think one or two trades this week. I looked at I'll just count pinch point. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22. I've looked at 22 stocks this week. I've taken one trade. I priced out all of them. Okay, one trade. So it is a quality over quantity. My pinch point scanner is giving me quality, but sometimes if I want to trade options, I'm a little bit pickier, right? Like I don't like a stock that's going to move $5 that has a $5 wide strike price. That to me gives me no precision in the trade. So anyway, it's awesome. Like I love the dashboard. You can have a fully automated trade idea that gives you the expected move, the plus or minus on the market maker side. If it was a directional bias with real time momentum, where's it likely going to go in this next cycle? So pretty straightforward, but very user friendly. And I was really happy with how it all turned out. And the pinch point's awesome. So we did like 2.5 weeks of master classes, spent a lot of time with the members. And now moving forward, it's everyone that's trading with the scanner and has my alert service to go with it. That's who's going to see me in the live classes now. Okay. All right. What else? There's daily profit play, waterfall income, double up, newsbreakers, pinch point, crash insurance masterclass. Crash insurance. This one is one of the more cost effective services. This one is a $197, so it's $197 to learn how to protect your portfolio. I don't think you can put a price tag on having insurance on your portfolio that can save you tens of thousands of dollars. Like this year, allowing myself to have what was maybe at most like a 6% drawdown during March and April at its worst, about a 6 or 7% drawdown to come out 20+% on the upside. It's because of a very simple approach to strategically hedge your portfolio. I hedge. You can hedge individual stocks. You can hedge your core positions. If you like the stock, you can obviously protect your position. You can hedge indexes. You can also hedge and speculate for income. There's obviously cycles in the market where if I believe the market's going down, I can place trades to benefit from a bearish move. Okay. But more importantly for me, it's defending my portfolio. If the market's going to drop 20%, I don't want to be on the hook for a full 20% drawdown. If I'm more exposed to stocks that are going to drop a lot farther than the broader market, I don't want to be a hook for that type of risk either. So it's protecting your portfolio without breaking the bank. Okay, like I'm talking about like 0.25 to 0.5% risk for 5 to 1, 10 to 1, or greater hedges. They don't always work. right? Like sometimes I will literally waste a quarter 1% in a hedge. And I might risk that multiple times in the year. And I might risk 1 or 2% of my entire portfolio. But if that 1 or 2% doesn't pay, the flip side is the up side of the market should take care of it. So rather than me making, let's say 20% for the year, I make 18 because my hedges didn't pay out at all. Or I make 19 because my hedges didn't pay out at all. That to me is still a lot better to sacrifice that little tiny 1% to still have, 90+% of the upside participation and maybe beating the markets, maybe beating the benchmarks. But it's a lot better to do that and sacrifice that little tiny fraction than it is to sit and watch the market be down 10, 15, 20% and you're down right alongside it the whole way, fully invested, not with no dry powder. That's one of the worst positions. And look, I experienced that recently. I was so confident and cocky in 2020 and 2021 that I stayed pretty much fully leveraged going through 2021 and into the 2022 drawdown. So I mean, I came out okay in 2022, but it was mostly because of currency trading and some hedges. But it was not easy to see. I had very little dry powder going into 2022. I had a ton of profits from that 2-year melt up. Um, but if it wasn't for like a collar trade, if it wasn't for buying some puts, if it wasn't for aggressively trading like inflation commodities in the beginning of 2022, energy stocks did really well for like the first 4 months of the year. Those were huge returns to like kind of help me break even the rest of the year. And then currencies, I battled the yen pretty aggressively and made some profit at the end of the year. It took a while, but the yens were okay for some hedges. I was getting my butt kicked on the dollar yen for a while, but I ended up making it back. And then trying to think, like I had some big positions close out in 2022. So currencies helped me be profitable. Some hedging helped me a ton to at least weather the storm. And having kind of this kind of bifurcated market where like energy inflation was a really good trade for the first 4 months, and then everything topped and went down together. It was not an easy year. It wasn't. I mean, I don't know. It was a weird year. It wasn't like a crash. It was just like a steady, you know, bear market. Everything was like down, rallied up, down, rallied up, down, rallied up, down again, broke the trend line. All of a sudden, we ripped up in Q4. But it was a solid like 8 to 9 month drawdown. Okay. All right. What else? I've got a couple more, and then I got to go. Crash Insurance Masterclass. I also have my Project Options Edge. Right now, I will give you an example. Project Options Edge. This is one of my discretionary services. So this is a lot of discretionary trading. I would say this is more. I'm not going to say advanced. I mean, look, if you're willing to learn, it's not advanced. I'm not trading to be like, look at all these crazy, sophisticated things I can do. I'm just trading to make money. I have capital that I don't mind tying up like, $3, $4, $5, $10,000 worth of buying power for some of these trades. So it's discretionary in the sense that I can use my core positions to generate income. I can use my core positions, tie up some buying power to, have an income trade, like a ratio spread, a diagonal spread, a 1-1-1, which is where I put on a bear trap and then have a naked put. Like it's a little bit more expensive to place the trades, but there's a plan B and a plan C. I intend to make these trades win. We've only taken one loss in Project Options Edge, and that one loss was fractional on Spotify. I'm going to go to my tracker right here. Stream. Okay. Let's go to project. So we've had winner on Intel, Gold Futures, Netflix, Uber, Hims, Spy, Qs, Google, AMD, IBIT. Took a loss on Spotify, but I'm winning on the put side. And then we have some open positions that are all looking pretty good. I have open positions on Airbnb, CrowdStrike, Russell, Johnson & Johnson was a winner, Altria, PayPal, Dell, Robinhood, Pepsi, Lululemon, Dutch Bros. I put an oil trade on. So I mean, there's a lot of trades. We've had a lot of winners, but and that's, I mean, in a way, it's like that's probably the closest thing to like, how do I trade for my clients? This is discretionary, right? So I do a lot of waterfall income trading for my clients. I do a lot. I mean, I do a ton of Project Options Edge trading for my clients, but I'd say waterfall is easiest for me client wise. This is personal. This is for clients and me because it's such a good trade that it's spoon feeding me. Crash Insurance is everybody. I mean, I'm obviously going to insure my client portfolios. I'm obviously going to share my portfolio. So, and this is what I do. Okay. Am I still holding? Yes, I'm still holding all the hedges, Larry. They're they're there. I mean, if they work, they work. If they don't, they don't. I get it. I'm sacrificing the debit. Okay. And then lastly, I think, is there one more thing here? So I have all access on this stuff. If you want to just say like, look, I like all Chris's services. I want to be able to trade, some of the things that he does. I mean, if you're essentially bundling multiple, you might as well ask for like the Diamond Club or the All Access. Okay. I feel like I'm missing one thing. Maybe I am, maybe I'm not. But I know I have. Yeah, we'll go from there. So it's a lot, but you just see there's not a lot of overlaps. These are all very very different services, and that's by design. I mean, I'm going to trade a lot of different ways to be profitable. So again, and maybe this is too much. Maybe this is like, oh, this seems crazy. I could do one strategy, be really good at it. It's very true, right? I've got a lot of traders that just do this. I have a lot of traders that just do this. Okay. I have a lot of traders that are just going to do this because the scanner is helping them find great trades. I think this is something that for 190. Oh, I was going to add here practical options. Practical options. I have a $27 course, and I have a $497 course. This one is basically covering long calls, debit spreads, credit spreads, long puts, debit spreads, credit spreads. Full course covers 13 of my favorite option strategies. So my go-to, the way I think about the market, up, down, sideways, 13 of my favorite strategies, all on demand. It's on my Discord. Okay. All right. That being said, I will wrap it up there. I'm going to jump into my next session. If you're in some of my services, maybe pinch point today. Let's see here. I do have some time. Maybe we can jump into pinch point this afternoon before I go live on YouTube. I mean, I don't know. I think I'm just going to do a video for YouTube today. 3 to 4 p.m. There's no final hour. The market's closed. I might just post a video. I'll probably just post a video through TradingView and then blast it on my socials. Let's save a class for tomorrow. Let's save like pinch point. Let's reconnect tomorrow. I'll get something in the afternoon. So anyway, I'm going to jump to my next session. I appreciate everyone being here today. If you are interested in any of these services, if you're interested in learning more, you can go to prosperitypub.com. Okay, so let's go support at prosperitypub.com. Okay, also, if you're in my live sessions here, for any Prosperity Pub member, if you're in my services, I share my email. So if you need me for anything, like all my members that are in these classes, I have an email that you can contact me directly. But I'm in my Discord every single day. But give the team a shout. I mean, if you need me for anything, support at prosperitypub.com. Ask about the services. These are all available. Cheapest one would be $27 on practical options, $197 on crash insurance. Daily profit play is like $8.95 or $8.97. The other ones are anywhere between like $9.97, $12.90, whatever. I'm not asking for anybody to just fork over and join me a bunch of services. I'm just saying I've got a little bit of something for everybody. And the reason I do that is because I'm trying to make money. Up, down, sideways, from short term, medium term, long term, I'm trying to make money. Best way I know how. Make the most amount of money I can, safest way, least amount of risk. That's it. Okay. All right. Thanks for being here, everybody. I'll see you soon. Thanks. Bye.